Good afternoon, friends. I am Ramesh. I am here to explain and demonstrate a product in the debt PMS space. So, first is what is debt, what is debt PMS, and what is credits. So, debt is the other side of, or credits is the other side of equity. It's more certain and it has a defined time period. So when you look at debt, these are the two things which is different from equities basically. And again, in that you have various market opportunities like you have in equity. So for example, you have the extremely large companies which are rated AAA and AA plus. Then you have the mid-sized kind of companies which are rated between AA to triple B, and then you have the small companies typically. So this credit rating also defines a universe. Not only so each credit rating will have its own different kind of yield curve. So broadly here we are there to discuss the mid segment of the credit debt market, and this is where the opportunity lies. So the product that we are presenting here today is basically looks at a 2 to 3 year horizon, which gives you a 9% net of fees, net of tax returns. So this is the bare bones of the product. And like in other markets, we do a lot of research to select the issuers. We use quantitative filters, we use lot of analytics, and we use lot of access to promoters themselves, to judge the investability of the company. And this opportunity is there at this level. And like equity prices, the interest rates or yields also change. You all would be aware that in the last to last meeting, RBI cut interest rates by 25 basis points. So these interest rates or security yields, they mean one and the same, uh, will tend to follow more macroeconomic and company specific factors to decide on the yield or the interest rate for that security. So this is the segment, and this is very attractive given the way India is developing. India is developing at 6 to 7% GDP growth rate. In this, the AAA companies are not equipped to handle all the credit needs of the economy. And therefore, the fastest growing segment is this mid segment, which is between AA to triple B kind of segment. And this is what you are seeing all around you. And they are best able to address the credit needs of this growing economy. So this product, very bare bones, 9% uh, post-tax, post-fees returns, and over a 2 to 3 year period. So this is the bare bones of the product, and this returns is per annum. So if you're invested in 3 years, it will be around 27% absolute basis. So this is the product. And why is there need for this product particularly now? We are getting lot of interest from the perspective of stability in portfolios. There are other markets maybe giving higher return in the short term, but from a stability of portfolio perspective, this fits in very well with particularly the HNI investors, because this is less volatile than investments in many other markets. Now we come to the topic where, how a PMS or AIF is better than a long-standing product called fixed deposits, which almost everyone has in their portfolio. So three things here. See, number one is taxation. This is much better in terms of tax optimization than a fixed deposits, but this point is pretty well known. Number two is from a concentration perspective. So, and number three is you'll have to compare apples to apples and oranges to oranges. So each bank will have their own credit rating, and banks, particularly the private sector banks and the not so well run banks, sometimes fall behind their payments like any corporate in securities side. And hence the FD is also subject to, or the securities from that bank is also subject to credit rating upgrade and downgrade. So for these three reasons, it is better to, from a portfolio perspective, to and have more stability. It is better to move from FDs. Keeping a minimum amount is another issue, but better to move away from FDs to debt PMS. Now, the macroeconomic situation, as I started with earlier, what is happening is there is, from an earnings or from a fundamental perspective, there is a global slowdown which is happening. Number two, India is at the crux of a crucial macroeconomic political event, which is the election. Post that, things will settle down. India and this segment offers an opportunity to grab this arbitrage. So about 2 years back, the spread between A plus rated security and a double A plus rated security was about 350 basis points. Today, it has shrunk to about 300 basis points. Now, this will keep shrinking, and this is where the capital gains also happens. And this ability to lock in yields for the next 2 years, 3 years also happens. So you have two things. As interest rates come down, you have capital appreciation. Though in this segment, capital appreciation will be less than AAA. But in this segment, you have higher yields. So that more than makes up for when you look at the return from compared to AAA and compared to FDs. And hence, this is the best product from a portfolio stability and a portfolio growth and income perspective. Then the last point we want to add is, see, there are, in the PMS, there is a lot more flexibility compared to other forms of investment. So you can have NCDs, which is non-convertible debentures. Typically, non-convertible debentures pay semi-annual coupon and return of principal at the end of the tenor. You can have other instruments which are more tax efficient, called CTC NCDs, for example, which is structured in such a way that beyond 12 months, it gives you better tax, net of tax returns than an NCD. But this is not of interest to other players like mutual funds because they don't benefit from it. Then you have other instruments like perpetual bonds, which many of you might be familiar with, which is like quasi-equity and quasi-debt. And you have CRPS or preference shares. Again, each type of instrument has to be tailored to the risk return liquidity requirement of the investor. So this is the broad presentation. One is what is the debt credit market. Second, what is the product, what it is going to offer you. From a product perspective, what we want to present is, see, this is ideal for HNIs. And however, apart from the HNIs, see, typically HNIs tend to be part of senior management in companies or run their own companies. And this is the key to the entry to their treasury operations also. In terms of trust, in terms of delivery, in terms of ability to tailor a product to their needs. So this is where that push and that depth will come from. And this is expanding. We are seeing a lot more people interested and a lot more people making use of this opportunity.
I think how how would you, Ramesh, how would you see this vis-a-vis FDs? Because Ramesh, lot of HNIs would have FDs and they are comfortable with FDs. So why should a debt PMS from Prabhudas Lilladher and a debt PMS from Scient Capital, because they are exposed to debt FDs, and how it is better? If it is better, is it better? Now that's a question.
So it is definitely better than FDs on broadly three counts. One is there is more liquidity here compared to an FD. FD, you're locked in for that period. If you want to break the FD, then you lose interest and you might have a prepayment penalty of 1%, 2%, whatever, depending on the bank. Number two, it is more tax efficient. This is a very important point. In terms of tax efficiency, this is so net return, net return in the hands of investors. This is more optimal than an FD, a pure FD. And number three, depending on the FD and the bank, you need to compare apples to apples. So you have the problem of concentration risk, though, historically, India has not been affected by it. And you have the issue of the right credit. See, every bank is also rated by a credit rating agency. So you need to compare like to like in terms of the risk you're taking, whether it's an FD or a corporate deposit with a corporate. So that corporate will have its own credit and risk, rating. And that is important to compare like to like. So on this like-to-like comparison, the PMS is far more efficient and far better as a product to provide stability and returns in the client's portfolio. See, there is a portion available in the client's portfolio for growth kind of investment. This is for the stability and long-term income kind of investment for the clients.
Second question, Ramesh, is in FDs, I get a certain amount of returns, which I book that, lock that kind of return. And most of the FDs, they gave me returns, it's on an accrual basis. So in a debt PMS from Prabhudas Lilladher and Scient Capital, is it just like an FD? Will I get all the money on an end of the tenure? Or if I am a retired person or I am looking at a cash flow, I have some structure can be worked around in debt PMS that I have a regular inflow of cash?
Good question. See, debt PMS is very flexible. Here we can create a structure and specific solutions for certain clients where not only can we optimize tax, we can optimize the cash flow payments. So if a client wants a monthly payment or a quarterly payment or a semi-annual payment, we can optimize that. The only caveat there is any client who wants more higher frequency of payments has to live with higher taxation rate. And third is we can also optimize the of and in terms of the upside potential and return. So when you come to a debt PMS, so debt PMS, number one point, back to basics, is more certain of returns than other asset classes. So you are 90% assured. It will be vary by 1% or 2% in terms of interest rate movement or something. But if you hold till maturity, any debt security, you will get the return that has been promised. So this is the beauty of the debt PMS.
Third question, Ramesh, that if I go for an FD, I have to pay tax, and the tax is at about 34.5%, including all the cess. So if I have a fantastic return in debt in an FD, which is about, say, in the name of a senior citizen in the family at about 8%, my net post-tax return in a FD is just about 6.5%. If I choose a Prabhudas Lilladher and a Scient Capital debt PMS, if it is going to give me just 6.5%, why should I choose a debt Prabhudas and a Scient Capital debt PMS? I will choose an FD. So on a post-tax basis, is it the Scient Capital and Prabhudas Lilladher debt PMS a different return?
So compared to a 6.5% post-tax FD return, here we offer a 9% post-tax return. Now, this can be customized to even increased depending on the taxation rate, with the caveat that cash flows will have to be adjusted. So investors who are looking at far higher return will have to look at back ending of cash flows rather than more frequency of cash flows. But as it stands today, because of this opportunity and because this is the growing segment in India, we can offer a 9% per annum post-tax return. And mind you, if you're invested for 3 years and this is 9% per annum, your absolute return is 27%.
Wow. So Prabhudas Lilladher Scient Capital Debt PMS can actually give you mean to say an expected anticipated return of close to 9% post-tax,
Right.
compared to about 6.5% on a FD on a post-tax basis. So if I am taking that much higher return, you talk about Ramesh ji, you're already talking about 50% better return. So what are the kind of so are these? I would assume these are very, very risky papers. These are definitely not double A paper or A category paper.
So compared to a AAA paper or an FD with, say, State Bank of India. State Bank of India is, of course, the best credit quality that you can find. Compared to that, this is slightly more risky. And that is where Scient and Prabhuta's capability comes in. Our due diligence, our research, and our methodology and process. We have seen in the past 2-3 years a lot of defaults happening in the economy among big companies, including AAA. We have not had a single default in the past 3 years in this strategy. And how we have done that is we are very firm on due diligence, process, and getting the right risk return trade-off whenever we invest. So if a bad company is giving me 6%, I will never invest. Or if a good company is giving me 12%, I might go for it. So those are the mechanics day in and day out with a full research team, a full markets team that we do. We process. The process involves 3 pillars. We have a quantitative decision support system which looks at things objectively. Then we have the analytics piece, which is very detailed. We, we don't want to boast, but we do far more detailed analytics and analysis of companies than many mutual funds, for example. And the third is, of course, the access to the promoters. That is very important to judge the intent to repay in the credit debt market. So this 3 pillars has helped us and has proven us time and again the replicability of our returns. It's not that 1 year we have given or 6 months we have given. This has been replicated. Of course, it will go slightly up or down depending on interest rates in the economy, but that is marginal. Maybe 20 basis or 30 basis up or 30 basis down. That is marginal.
Last 3 more questions to go, Ramesh ji. What if I'm a RM, I am a partner, I am a distributor of Prabhudas Lilladher. What should I tell to a client to have their part of their allocation, some of their allocation on a debt PMS? Not necessarily with Prabhudas and Scient, but a debt PMS, why they should have that, number one. Number two, if once they have taken a decision to have a debt PMS, why they should think about having a debt PMS exposure to Scient and Prabhudas Lilladher.
So, very important question. See, from a portfolio perspective, a debt PMS will provide stability, irrespective of which debt PMS. A debt PMS will provide stability. Those who are looking for stability hitherto were mostly invested in FDs. So, and hence the second point, which is this is much more efficient and higher returns than FDs. And number 3 is looking at the current macroeconomic situation where growth is slowing. interest rates are coming down, this gives you a far more, on a long term basis, a far more certainty in terms of returns compared to other markets. So these are the three reasons why clients should look at debt PMS. Again, they can do the asset allocation depending on which market and risk they want, but they should look at debt PMS. Now coming to Scient Capital and Prabhudas Leeladhar, see, there are other debt PMSs, but if you observe, number one, typical debt PMSs are beholden to their own securities in the portfolio. So you go to them and say, we want a different security, they are not able to provide. So you are exposed to the risk of their sourcing, of their origination. Here, in terms of accessing the securities market, we work through at least 7 to 10 kind of entities. So we are not beholden to any one entity in terms of sourcing the security. And that is important because that gives us impartiality. We judge from afar. We test these securities based on a research, and we don't, buy them because we already have them in our portfolio. No. So that gives us impartiality. There are one or two other PMSs like us, which is where our methodology comes in and our process comes in. So with Scient Capital and Prabhudas Leeladhar, the processes that we provide, the due diligence that we do, the research that we do, the access to promoters and entrepreneurs that we have is what gives us the edge. As I explained before, this whole process, capability, research, having a quantitative decision support system, analytics, and access to the promoters, entrepreneurs is what gives us that conviction and performance track record compared to others.
So I'm convinced now, Rameshji, that you just covered that compared to 6.5 on an every return. If I choose a Prabhudas Leeladhar and a Scient PMS, it gives a better return to my client. It is more transparent because it remains on the demat account of the client. It is in the custodian of the client, so the client is in more control. I also understand, but Rameshji, what is it in it for me as a partner, as a distributor, or as an RM of Prabhudas Leeladhar? Clients need allocations, but if we distribute this, the clients get benefit. But what is it for? What is in it for me? If I distribute an FD, of course, he buys it, I get nothing. So, is there a kind of remuneration, commercials involved? Does Prabhudas or Scient give me a kind of some incentive for distributing this kind of debt PMS?
So that is definitely the case, and this is beneficial both for clients and for RMs.
Okay. So can I expect that in an FD, if I sell it for a bank, I get no incentives and no commissions, right?
Whereas here you will get 3% upfront.
Oh, so if a client buys an FD, I get nothing.
Yeah.
But if client buys a debt PMS, which is more transparent, which he has got more control, so it's a better product for the client. And as a partner, I still get 3% upfront.
Not only that, plus a setup fee of 3%.
Which is the
which we will take from the client and involves mostly operational costs.
Fine, great. And last, Rameshji, if a client has an FD, a client may be working somewhere, he may be having his own company, and he may be having FDs in his company and in his own enterprise, which never comes to us. Now, if the client is an HNI and he's either working, he buys the PMS from Prabhudas and Scient, he's either working in a senior position in an organization or he runs his own enterprise. So can we also give treasury solutions and make some give him a better solution, and not only for his personal wealth, safeguarding his personal wealth, but also for his organizations?
Yes, most definitely. And this is where treasuries have the mandate to invest in similar solutions which we can offer. So this not only opens the doors for treasuries, but also for HNIs for stability in that portfolio. See, you can offer much more, almost the entire gamut of solutions, financial solutions that are required by both companies and HNIs, who could either be senior management or could be entrepreneurs and promoters themselves, on a tax efficient, stable, higher return basis. So these are the three pointers: tax efficient, stable, and higher returns.
Wonderful. Thank you, Rameshji. I have no further questions. Deepak, you are the head of third party, and some from Sandeep sir's team. Do you have any questions to Ramesh?
Uh, well, only that, Ramesh, I believe we would need regular interactions like these in future, and is of course sales support on the field.
Definitely.
And I'm sure anything is there, the team should write us on wms@plindia.com, and we could put across the questions to you and answer their queries.
Sure. So I'll just repeat, it is wms@plindia.com.
Thank you, Ramesh. And if they need, we expect that you can come on telephone to help us if we set up some meetings with somebody who's interested in this product.
Sure.
So thank you.
Thank you all for watching. Any queries, please email on the wms@plindia.com. Thank you.